Hello and welcome to FT Markets. Today we're going to be discussing the possibility of a rate rise from the Federal Reserve for the first time in 9 years. The question is, what does that mean for fixed income investors who have faced a low rate environment for the last 6 years since the financial crisis? To discuss these questions with me, I'm joined by David Riley, Head of Credit Strategy for BlueBay Asset Management.
Hi.
Thanks for joining us. So I guess the first question really is, are we going to get a rate rise?
Well, it's interesting that even after 6 years into the US economic expansion and all the forward guidance and the monitoring that's going on, the market is actually still not sure. It's at the moment only pricing in something like a 1 in 3 chance of a rate hike in September, and then something like a sort of 60% chance by year end. Certainly, we think that the Fed will raise rates before year end. We think it's most likely to do so in September. But really the key issue is how far and how fast do they go in terms of interest rates. And there, the market is very different to what the Fed is saying and what history has been telling us.
So I think we've got a chart here of the expectations for the rate rise. So as you can see, it really looks like this idea that we're definitely going to get a September rate rise has been fading.
Yeah.
But let's assume for a second that we will get a rate rise at some point this year.
Yep.
What does the outlook like beyond that? How far are rates going to go?
Well, at the moment, if you looked at forward markets, then they're really pricing in something like a destination for the Fed of around about 2%. So if you think the Fed's going to get close to its inflation mandate of 2%, it's really saying that we're going to have zero real short-term interest rates for a prolonged period of time. And that, as I say, is much more dovish or pessimistic about the outlook than the Fed is, and speaks, I think, to some fundamental secular shifts that have been going on both in the global economy and in the level of debt, which has implications for fixed income investors.
And in terms of the level of debt, I think you brought another chart with you here which shows sort of debt globally. Now, we can see here that debt has been rising quite substantially over the last 3 decades. But on the other hand, this is just money which is owed to each other. Debt has gone up, but so have assets. So we all just owe money to each other and we're all much richer as well. And so when you put that in the context of just a 2% destination for rates, I mean, do we really have to worry about this? Is this really a new world that we're looking at?
Well, I don't think you can assume away a debt problem by saying that for the world as a whole, sort of net debt, if you like, is zero, because the issue is that there are distributional issues between creditors and debtors, and the ability of debtors to meet that debt load. And what we've got here in terms of the red line is showing the total stock of government and non-financial corporate debt as a percent of GDP. As you mentioned, Dan, that's been steadily rising, including since the financial crisis, stands at more than 260%. And I think there was a recent study by the Bank of Canada highlighted that actually sovereign debt restructuring and default is actually more or greater risk or an increasing risk than it has been before. And at the same time, if we look at the blue line, world real interest rates have been declining. So sort of 101 economic theory would tell us as we get more indebted, those real interest rates should be going, if anything, higher, and it's actually been going the other way. And I think this is one of the reasons why actually the market is pricing a very low destination rate for the Fed, because it's saying the debt burden is still too high. The world can't afford high real interest rates given how high this level of debt actually is.
So the amount of debt has been rising whilst the cost has been falling. So obviously, as interest rates go up and the cost of that goes up, we might have a problem. So what then should investors be doing, or how should they be thinking about the implications of this as we're investing? I think we've got one more chart here which you can speak to in terms of, so here we have interest rate risk as measured by duration. That's the sensitivity of bonds to rises in interest rate. And then we have yield to worst, the minimum yield you would get from holding, say, a typical bond portfolio, the aggregate index there. So again, this has been coming down, interest rate sensitivity has been going up. So what should we be doing to prepare?
Yeah, absolutely. I think that is the crucial question that fixed income investors have been looking to address, because it's been great to be invested in fixed income and in particularly government debt, because you've had this decline in interest rates. So you've had this 30-year bull rally. That's now coming to an end. We do think the Fed is going to start raising rates, even if it's only to a relatively low level. And with this red line, as you say, the interest rate sensitivity of those benchmarks that people have been tracking, and where you're taking ever more credit risk as well, because by definition, in those benchmarks, you end up buying more heavily indebted companies, more heavily indebted governments. So I think the challenge that fixed income investors have right now is, as we approach this inflection point, how can I preserve capital, and how can I continue to generate income as a way of managing my overall portfolio? And so what we've seen is a rotation, not actually the great rotation, fabled great rotation from fixed income to equity, but actually a rotation from sort of traditional sort of benchmark tracking into government bonds type strategies into next generation fixed income, where there's much more emphasis on the preservation of capital, and where you're looking to get returns not just from interest rates, but also from credit and from liquidity and from things like term structure as well.
I mean, but I guess just the final thing there, though, is stocks have gone up so much as well that so we tend to think about bonds getting expensive, but then stocks, which everybody owns as well, have gone up a lot. So just to maintain that balance means people are going to have to carry on holding a very large amount of fixed income. So if we're not talking about people selling fixed income as a whole, is there really enough of these capital preservation vehicles or credit to sort of see any real rotation within the fixed income universe?
Well, I think we are starting to see that, because we have a situation where a lot of investors are learning that the core traditional fixed income is no longer quite as safe as they thought. We talked earlier about credit risk, but even setting aside credit risk, you actually saw a level of volatility and drawdown on your returns during the Bund shock, which was associated actually with equity. The idea of being safe is not only safe from a credit point of view, but also from a volatility point of view. So I think what we're seeing with investors is to recognise that with interest rates so low, likely to stay very low, that provides you very little cushion against this volatile and uncertain world. And so you do actually have to move into next generation strategies which actively manage that and preserve your capital, because it's not as safe as it says on the tin.
Thank you very much for joining us, David.
Thank you.
And so, as the Fed may be about to raise rates for the first time in 9 years, the questions for fixed income investors are clear. The world is going to change, but how?